Okay, in this video, we are going to talk about targeting a certain amount of money, certain cash value, and properly setting expectations. So it is fairly common to work with individuals that want to know, hey, how much do I need to be able to pay into a policy per year to retire with X amount of dollars? Here's how much I want in retirement in my cash value. Or in 20 years, how much do I need to be able to pay in per year, Steve, in order to have $1 million in total cash value? What's it going to require on my end as the individual paying in? Because often it's the other way around. How much do I want the ability to pay in, or how much can we pay in based off of our current situation? That's often how we design policies. But it is common to hear the flip side is, hey, I love this idea, cash value life insurance, safe, liquid, tax-free, no lost opportunity cost when the money keeps moving forward for me. So how much do I need to be able to pay in to target this certain amount? So two things we just mentioned, right? I want to retire with X amount of dollars. Or how much do I, if you're the agent and I'm asking you, how much do I need to pay into a policy for the next 20 years in order to hit $1 million? We're going to look at this example. The thing is, when we talk about setting expectations, this is critical. What is often shown, which is perfectly fine, is showing the current assumptions, the current dividend rate, or the current assumed rate if someone's showing an IUL or a different product. But what is very, very critical here, because these rarely happen. It's the truth. It rarely happens, especially today. We're in 2020. The next 10 years, insurance companies are expecting dividend rates to gradually trickle down. They've stated that numerous times, and it makes sense with what's going on in the low interest rate environment. So if they come down for 10 years, it's going to be quite some time before they get to a high level again. So looking at current assumptions based off of a company's present dividend rate is perfectly fine to do. However, it's good to look at conservative assumptions. And if I really want to set expectations where I go in expecting the worst and then I get better values at the end of the day, hey, then I'm happy. That's what I'll get if I look at the guaranteed values. If I look somewhere in between, the current and conservative or conservative rate, that's a good way to properly set expectations, in my opinion. So we're going to look at an example here on a 45-year-old male, age 45, with the above question. How much does he need to pay in order to have $1 million in 20 years? Let's take a look. So what we've got here first is a best case scenario, which is what's often shown, meaning what is the lowest amount of money I need to be able to pay into a policy per year in order to get $1 million in 20 years. Now, there's nothing wrong with that, but again, setting expectations, what I do not want to do if I'm an agent is tell you, hey, here's an example where we're paying $34,000 per year. So this is based off of the best case scenario. Let's take a look at this one actually. Best case scenario, if you pay in $34,000 per year, by year 20, Mr. Client, you have how much? Just over $1 million. So this is based off of a company's present dividend rate. Numbers look good. Okay, strong. But again, this was a best case scenario. So if things go perfectly or exactly as they are projected to do so right now in 2020, that's what I can expect to see from a cash value standpoint based off my goal, $1 million in 20 years. And a lot of times that's it. Okay, sounds good. Let's pull the trigger. However, what happens when we look at a more conservative scenario? One, we see the break even is slightly delayed. These are all designed with maximum cash value, attempting to target $1 million in year 20. Conservative scenario, what do we have here? $910,000, right? So it's about $100,000 less than the best case scenario. $100,000, that is a decent amount. I want to be aware of that. I don't want to be $100,000 short at the end of the day. Same product, same company, same health rating, same ratios. We always keep everything apples to apples. Then on the far right, we've got the guarantees. So worst case scenario, break even is very delayed with this particular design between years 11 and 12. What's my cash value? Year 20, $770,000. Conservative 910. I'd even go a bit lower than that. I prefer to run that a bit more conservative. But then best case scenario, over $1 million. So where an issue pops up, will it do this poorly? No, they never have, right? If you look at especially the top insurance carriers, they've operated in a non-guaranteed environment for the past 150 years. That's talking about present dividend rates, present term costs, present rider charges, all that good stuff. But what I don't want to happen is to head into a situation expecting that and then see it hit, let's say it hits 830K or something like that, where I am significantly short. Even if it hits 900, again, I purchased this with the goal of targeting $1 million in 20 years, and it didn't happen. That's where one can be upset, understandably so, because you told me that's how much I needed to pay in. So when it comes to setting expectations properly, what I would look at is reversing all of this. Meaning, if I look at the guarantees first, so here we're going to look at the same product, but based off the pure guarantees, how much do I need to pay in order to get $1 million? So again, same product, same death benefit, all that good stuff, paying in $42,000 per year instead of $34,000. And look at this. So we've got the guaranteed values on the left this time. $1 million. Conservative, 1.1, and then best case scenario, 1.28, almost 1.3. Depends how we want to approach the situation. If I approach it in this manner, where I've got $1 million guaranteed, will I have more than that? Probably, but I know no matter what happens, as long as I make those premium payments, that's how much I will end up with cash value at the end of the day. Again, because this was based off the pure guarantees. Another thing to look at here, to be fair, is how much have I paid in? $840,000 over 20 years, and I have just over $1 million, right? So based off the guarantees, is that attractive? Not really. But again, seeing everything up front. Based off of these examples, realistically, maybe peg it at 1.1, 1.12. When I say that, guarantees, and then the conservative figure is 1.164. Good to be just aware of all this and properly setting expectations. And again, what you can do with this, and this is the fun part, is if one says, okay, like my goal is to hit $1 million in 20 years. How much do I need to pay in realistically? Not based off the guarantees, because that's worst case scenario. Can I pay in $38,000 or $40,000 to hit that? If we were to illustrate a lower dividend rate, because you can do that with a whole life product with about any insurance company, can easily kick the dividend down, can't kick it up, but you can kick it down. You can easily demonstrate that. That, in my opinion, is a great way to set expectations. And another thing to look at is historical performance. So dividends have come down really with all insurance carriers, and they'll likely continue to do so. But at the same time, regardless of the dividend rate environment, what carriers have consistently produced among the strongest cash values to policyholders? That's a good thing to look at to know, okay, can I somewhat bank on my cash value and death benefit hitting a certain target in 20 years, in 30 years, whatever my goal is. So hope this video was helpful. If you have any questions, feel free to reach out anytime, and we'll talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.